Good morning. Why mortgage rates move so fast and the bond market secret most borrowers never learn. And most homebuyers believe mortgage rates move because banks simply decide to change them. In some cases, that is true, but in the grand scheme, that's really not how it works. And mortgage rates move quickly because they're tied directly to the bond market, and specifically mortgage backed securities or MBS, closely tied to U.S. Treasury yields. And when investors buy or sell bonds, mortgage rates react, and sometimes within hours. And understanding this relationship is one of the biggest advantages a borrower can have when planning a real estate purchase or refinance. And as a mortgage broker and capital markets professional, helping borrowers understand these forces allows them to lock rates strategically rather than just reacting to headlines. And mortgage rates are set by the bond market. And mortgage lenders really don't randomly choose interest rates. It's usually tied to an index plus a credit spread. And instead, lenders will price loans based on what investors are willing to pay for the mortgage backed securities. So here's the simplified flow. Banks, they originate the mortgage loans. Two, they're bundled into mortgage backed securities. And investors buy and sell those securities in the bond market. And mortgage rates adjust to maintain investor demand. And if investors demand higher returns, mortgage rates rise. And if investors are willing to accept lower yields, mortgage rates will fall. And this is why mortgage rates can change multiple times in a single day, because it's a back and forth. So why mortgage rates change so quickly? Well, recently with everything in Iran and other economic forces can influence the bond market and therefore mortgage rates. Main reason is through inflation data. And inflation is the largest driver of where interest rates are going, upwards or downwards. And when inflation rises, bond investors demand higher yields to compensate for the loss of purchasing power. And that pushes mortgage rates higher. So key inflation reports, we monitor CPI, Consumer Price Index, PCE inflation, as well as the Producer Price Index. And strong inflation reports often cause immediate mortgage rate increases. Two is the Federal Reserve policy. So the Federal Reserve does not directly set mortgage rates. However, their actions influence the bond market and it serves as forward guidance for the market. And when the Fed raises short-term rates or signals tighter policy, bond investors will anticipate being able to return less for yield, and mortgage rates typically move higher in response as well. So when the Fed signals easing or rate cuts, mortgage rates will often fall soon thereafterwards. Three is Treasury yields. Mortgage rates closely track the 10-year U.S. Treasury yield. And that benchmark acts as a real reference point for long-term borrowing costs. And as the end result consumer, you play that Treasury yield plus a credit spread is kind of how interest rates are determined. But when Treasury yields rise, mortgage rates usually rise as well. And when Treasury yields fall, mortgage rates will follow soon. So the fourth category is global investor demand, and mortgage bonds compete with other investments. And investors around the world allocate capital across U.S. Treasuries, as well as mortgage-backed securities and corporate bonds and international debt markets. And if global investors shift capital away from bonds, the yields will increase and mortgage rates will rise and borrowing costs increase. So why rates can move during many times in one day. And mortgage lenders monitor bond markets constantly. And if the value of the bonds drops within trading hours, lenders will often reprice mortgage rates upwards the same day or the following day, but more likely the same day. And this is why borrowers sometimes hear, man, the rates changed on me this afternoon. I got a quote yesterday and then it's different the next day. And it's simply the bond market adjusting. So what this means for home buyers. Understanding rate movements helps borrowers make better decisions is why. And instead of chasing the lowest possible rate, we can put your focus on strategy and timing. And experienced borrowers watch inflation reports, keep up with the economy, look out for Federal Reserve announcements, anything to do with Treasury yields or bond market volatility. And these indicators provide clues about where mortgage rates may move next. So why work with a mortgage broker and why it matters for you? And mortgage brokers operate closer to the capital markets than most retail banks do. So instead of offering one institution's rate sheets, brokers monitor multiple lenders and watch market pricing throughout the day and with multiple investors. So what this does is it allows borrowers to lock better rates in and at strategic times, compare multiple lender options, and we can adjust your structure to market conditions, but also navigate volatility in interest rates. In a fast-moving market, having somebody who understands how mortgage rates actually work can really make a meaningful difference. So, final thoughts for the day. Mortgage rates are not random. They feel that way sometimes, but not in reality. And they are the result of global capital markets where investors price mortgage bonds based on inflation, economic data, and interest rate expectations. And once borrowers understand that mortgage rates are driven by the bond markets, they can start making financing decisions the same way professional investors do. Now, if you're planning on a purchase or refinance, or if you're thinking about investing in real estate, understanding these forces can help you make smarter financing decisions. That, my friends, is it for the day. Please visit my website, billrapponline.com. Reach on out. Love to have a conversation with you. Have a good day.